Well, welcome back to the channel, guys. So today we have Steven Nguyen. He's actually a fellow YouTuber who talks about multifamily investing. Super cool. I've been watching some of his videos. I think our investing kind of mindset is very similar. And so I kind of wanted to have him on today, talk about multifamily investing, specifically how to find multifamily, which is kind of what I'm looking to do this year. So I pretty much just trapped him here for an hour so I can ask him my questions and you guys can learn from some of the questions that I'm asking him as well. So yeah, what maybe Steven, you can start off by, giving a small 30-second introduction about yourself and we can kind of go from there. What is your, what are you up to right now? What does your portfolio look like right now?
Yeah, hey Michael, very excited to be on and to share my journey. So, kind of at a high level, as you mentioned, I'm a pharmacist. I work as a pharmacist full time since 2013. And while working as a pharmacist full time, I've at one point scaled up to a 90 unit real estate portfolio, which consists of single family homes in California, which is where I'm based out of. And I started off in the Bay Area, California, which I know that's where you're at currently. And then
Yeah.
from there, I upgraded to apartment complexes in Oklahoma. I got a 20 unit and 26 unit. And at one point, I had a mobile home park in Selma, Alabama. And I, scaled rapidly. I bought about 80 units in 8 months, I'd say.
Oh, wow.
But how my profile looks like today is I ended up selling my mobile home park for a loss. Happy to discuss much details about that later. But I sit at 52 units of real estate that cash flow between maybe $8,000 to $12,000 a month net, depending on the expenses. And I still work as a full-time pharmacist. So that's just kind of me at a nutshell.
Yeah, that's super cool. I do want to ask you a lot about the mobile home stuff. I think that's something that I've been looking into, but I wanted to specifically, since we don't have too much time today, I'm trying to keep this to 30 minutes just because that's a bite-sized video. I mostly want to talk about the multifamily, how you're finding those, and that's kind of the topic of today's video. But I wanted to kind of start off by kind of I like the bird's eye view strategy first, talking about that. Like, why are we doing this? From like a long-term perspective, is it to acquire as many units as you can? Like, is the goal to get to 1,000 units? Like, what is like the overarching highest level goal that you have with this approach with buying multifamilies and stuff like that?
Yeah, so my initial reason for multifamily real estate was for financial freedom, right? That's what we see a lot on the YouTube channels, basically to have cash flow to replace your W-2 income. So for me, single family homes in California, it's more appreciation play versus in multifamily, the more cash flow you have, you increase your NOI and that increases the value. So in multifamily, which I consider 5+ units, the more cash flow you get, the more it's worth. So it's kind of like you have your cake and eat it too, right? So you have cash flow and appreciation versus a single family home, it's cash flow or appreciation. So at a high level, once I kind of understood that concept, it just made sense to go 100% into multifamily. And so my overall arching strategy is to buy value add multifamily. The BRRRR strategy, I do instead of doing that for single family homes, I do that for multifamily, right? So I want to buy apartment complexes off market using direct mail, and I'll go into that deeper later. From there, I can see a margin in rents. Maybe the landlord hasn't raised the rents in 5 years, and let's say they're charging on average $500 in rent, but the market rent might be $800. So it's a $300 margin. But in order to get that $300 margin, you have to do renovations, right? So that may cost you, let's say, $10,000 per unit to get that renovation. From there, obviously you renovate it, you're going to rent it out at the higher market rents, you're going to stabilize it over, maybe 12 to 24 months. At that point, you do a cash out refinance to pull out your money, tax free because you're doing a bigger loan, and then use that to go buy another apartment complex. So that
Ultimate
was kind of my
scalability.
goal.
Yeah.
Yeah, that was basically my ultimate goal when I first went into multifamily.
Okay. So would you say kind of like the end goal from now is that maybe you own 500 units, cash flowing, three 30,000 to $40,000 a month, and then you can just quit your job and maybe live just chill instead of having to grind and
Yeah.
trying to own more of these properties?
Yeah, I honestly I was on that type of chase before. So my goal was 100 units, and I hit pretty closely. But honestly, the more and more I scaled, and I talk a lot about this on my channel, I've come to realize that real estate. Yes, I do cash flow like $10,000 a month, let's just say, but you're saving that cash flow for a rainy day if a roof breaks. Right. So if a roof breaks, it's going to cost me 40K. That's 4 months of cash flow that got wiped out. So, I was really chasing a certain number, but as I've owned multifamily for extended period of time, about I think 3 years now, I've come to realize that chasing a number sounds great in terms of flexing, but I think in reality, for me, it's just like really I'm debating: do I just want to pay these off, right? Do I want to
Yeah.
cash out, refinance, pull out the money, and scale, or do I want to maybe offload some, pay off my apartments, and have those cash flow even more? Because my cash flow go right now, it's probably about 20K a month to replace my salary as a pharmacist and then my future wife's salary as a pharmacist, and roughly we take home about 20K. So that's kind of I'm trying to pause and pivot. So it's kind of an interesting moment right now for me. But if you asked me like 3 years ago when I first got into multifamily, yeah, it would be like about maybe 40, 50K a month in cash flow and have like 200, 300 units. But I've kind of taken a step back, I'd say, in this past 6 months when I've been pausing and realizing that, you know what, probably if I got 20K a month and I could step away from my W-2, that's probably the greatest benefit in terms of my quality of life right now.
Yeah, I would say so. I think that's kind of what when real estate or newbie real estate investors get into this game, I think that's the kind of picture of financial freedom that they have in their mind is that they own maybe, 100 units, cash flowing, 20 grand. They can quit their job, live passively. And, we can talk more about that too. But like even me, I was analyzing or underwriting a 6 unit property. That's why I scheduled a call with you.
Yeah.
And I was like, should I buy the 6 unit? Like, I don't know. Like, I've never had six. I don't even have six tenants right now. I have 4 units. I have, just four tenants, and adding a 6 unit seemed like a lot of work. But I wanted to kind of pivot here, talk a little bit more about like why you chose Oklahoma. Like, how did you get to this market? Because for me, I'm in the stage where I'm like, okay, I want to buy multifamily, but like the first step is I need to choose a location.
Yeah.
There's so many locations. Like everybody swears that their market is the best market. So how do you just kind of hunker down and actually choose one? Did you do it based on numbers, or what was your
Yeah.
kind of strategy there?
So for me, I asked myself, like, where do I have an unfair advantage in? And basically, for me, that came down to two places: my own backyard, which is California, which is expensive, obviously, and then my other location was Oklahoma because I had a really great property manager that was referred over to me, right? So for me, that made my decision very easy. If you have a good property manager, they're hard to come by. It's easy to scale around them, right?
Hmm.
So because property managers make or break your deal. Like what I teach is if you have a good deal and a bad property manager, it's now a bad deal. If you have a bad deal and a good property manager, it's now a good deal. That's how vital property management is. So for me, the fact that I had a strong property manager in Oklahoma was a blessing. But on top of that, I like it because it's in the Midwest, so it's more of a cash flow market. It's low property tax, relatively speaking. It's next to Texas, but property tax is significantly cheaper than Texas. It's very landlord friendly. I can evict the tenant in 14 days. And I call Oklahoma, it's a steady Eddie market. It's not like super sexy like Phoenix, Arizona. It's like during the ups, it just kind of goes up a little bit. During the downs, it just stays the same, right? Versus some markets are more volatile. So I kind of like that to balance my California real estate, which is more volatile, right? It's definitely more highs and more lows depending on the time. So I just thought it was a good complement to my real estate portfolio. That's why I chose Oklahoma. But there's also job growth there, which leads to population growth, which leads to rented demand, right? So that's the
Right.
fundamentals of multifamily. You need jobs to have people there.
Yeah, I mean, as long as the numbers work out and there's population growth, I mean, you're looking at long-term appreciation over time. I think places like that have negative population growth are probably the biggest indication of declining property values, just because there's not going to be as much demand in the long term. So if this is a long-term investment, I think population growth is kind of the number one thing that I've heard is, one of the key factors. I guess what is your like buy box when you're looking at these properties? Like how would you kind of determine like how much to bite off here? Like, did you go? Is it by unit count, purchase price? What did you kind of start off? You went straight to 20 units, so it seems like that was kind of your what was your buy box when you first were looking for multifamily properties?
Yeah, my first one was a 26 unit and my second one was a 20 unit and my mobile home park was about 40 units, right? So, going from single family like yourself to 26 units, it can seem intimidating. But my buy box, and this is the criteria I use on PropStream when I'm finding my off-market deals for my direct mail campaign, is between 5 to 100 units. And why I do 5 to 100 is because typically that's going to be your mom and pop owners. Once you start getting above 100, that's when it's mostly syndicators and you're competing against syndicators. So for me, I want to buy from mom and pop owners. And realistically, it's probably going to be about 50 units or less are the mom and pop owners. And what's nice about those is they owned it for a long time. They don't treat it like a business, right? They just happen to maybe they own a business themselves and they bought it to offset some taxes and now they paid it off and they just want to like cash out their nest egg to retire. That's
Hmm.
two of the situations where I bought my both my apartment complexes. And so, it's basically criteria is 5 to about 100 units. Realistically, 5 to 50 is your sweet spot. You want them to own it. I do about 2 years at least, but realistically, if you want the more like, creative financing route, they're gonna have to own it for longer than that, right? Like at least, 15 years plus. And just you have to cast a wide net, right? When you're doing these data websites like PropStream, because they just post in the tax assessor's office. So
Hmm.
you want to cast a net and throw it. But the ones I've taken down, it's typically the owners in their 60s. They own this property for like 15 years plus. They haven't raised their rents in a long time. There might be some deferred maintenance. They might be self-managing the property, and sometimes they're their own property manager as well, right? So just think of this mom and pop who does everything themselves. And then
Hmm.
once you kind of speak to those, when I talk to those type of owners, I have a sense that, oh, this might be a deal that I can get. In terms of the price range, it depends on your budget, right? So for me, I was fortunate to have $1.2 million that I cashed out for my single family home portfolio. So for me, I was trying to strike in the $1 million under range, and you're going to have to put 25% down, right? So that's about 250K at least, and then you're probably going to have to put in between 200, $300,000 of renovation if you're buying value add real estate like me, right? So out the gate, you're already in for like $500,000 between renovation and down payment. So that's the properties I was trying to target.
So would you, so the deal that I brought you, the 6 unit, it was actually fully renovated. Would you ever go for a fully renovated multifamily? I mean, I feel like you're right. The move in multifamily, if you really want to uh, appreciate the asset forcefully, would be to add and renovate the properties, raise those rents. Because I think and this is the metric that I wanted to ask you about was cap rate. So cap rate is NOI, which is net operating income, basically your total income minus your total expenses, not including any mortgage payments, because that kind of depends on what terms you get. So it's kind of a variable that we kind of exclude from the equation. But you get your NOI. Let's say it's like $100,000. Divide that by the purchase price, right? So if it's 100,000 over $1 million purchase price, you're looking at a 10 cap. So when it comes to cap rate, I never quite understood this. Like for a given city or given market, is there like this like standard cap rate that everything seems to sell at? Like, how do you determine like if I say, okay, that multifamily is a 10 cap, like is that a good deal? Like how do you use cap rate to determine like what is this a good deal or not? Or why is that metric even used?
Yeah, that's a good question. And I struggled with this too when I first got into multifamily. And the way I understand it is, so basically the cap rate is how much you're going to cash flow, right? So a 10 cap market is going to obviously cash flow a lot better than a 5 cap market. But on the flip side, if you were to raise the NOI by $100,000 in a 10 cap market, the value doesn't go up as much compared to raising the NOI by $100,000 in a 5 cap market, right? So it's just kind of math. And at a high level, I wish it was more public information, but literally, your cap rate, generally speaking. So like California, it's a more of an appreciation market. You're gonna have a lower cap rate. So you're talking about maybe 3 to 5 cap. Right. In
Mhm.
Oklahoma, at the time I bought it in 2021, it's a higher cash flow market. So the cap rate was 8 cap. Another confusing thing is cap rates are based on interest rates. Cap rates will always be higher than your interest rate, right? So if interest rates today are 8%, well, you better believe in Oklahoma the cap rate's not 8 cap. If interest rates are 8%, it's going to be a 10 cap now. So it went up.
But why is that though? Is it because if they buy a property, let's say it's $1 million property with an 8 cap, that means the NOI is 80,000. Why would I not buy that property if it's an 8 cap? And assuming that I was going to get like an 8% interest rate on that, would the numbers not work out in that case?
Yeah, yeah. Sorry, I was explaining it from like a lender's perspective. So lender's
Okay, I see.
perspective, if they're giving you 8%, interest rate, they're going to evaluate, underwrite it at a higher cap.
Right.
But in terms of our perspective, right, as the buyer, as the investor, if let's just say Oklahoma is an 8 cap market, but I'm able to buy that asset
Well,
at a 10 cap, then at that point, that's a good deal, right? That's how I bought my real estate, right? I bought it at a higher cap rate, which means it cash flows very well relative to the
Right.
market.
I guess
Yeah.
another confusing thing was there's like existing cap rate, but then there's like pro forma cap rate, which is like here's what the cap rate could be once you renovate this thing, right? So like how do you like determine what cap rate you should be buying at, right? Because there are some properties that promise like, hey, like there's a lot of potential in this property. So would you be willing to pay a lower cap rate, right? If the promise was bigger that you could renovate and raise the rents more? No?
No, so you never buy on promise and upside, right? You
Okay.
buy based on what it currently, how it's performing today, right? And
I
that's the
see.
trap a lot of beginner multifamily investors fall into. It's why I fell into my multifamily deal, which is the deal I lost money on. And so you buy at the cap rate is. So for example, let's just say you have an A class, C class, and B class apartment complex in Oklahoma, right? A
Hmm.
class means it's I think 20 years or newer, right? B class is about maybe 20, 30 years, and C class is 30 years or older. Right. So most of these mom and pop owners have C class apartments. Mine are C class apartments. So I'm just making this very simple. So let's just say a C class apartment is an 8 cap, right? That means a B class might be, let's say, a lower cap rate than that. So it might be a 6.5 cap. An A class might be a 6 cap, right? So if let's just say after renovation, let's say you renovate your C class property, now it's almost like a B, then you can lower your cap rate a little bit. But to be honest, I don't want to depend on that at all. I just underwrite my as is deal and my pro forma potential at the same cap rate. So this is why syndicators, this is how syndicators, I call them spreadsheet masters, right? You can tweak the numbers however you want to make the value look better. And how they do it is they raise the NOI, they lower the cap rate. If you do the math, right, if you raise the numerator and lower the denominator, the value goes up, right? So these are all predictions, but they're playing with other people's money, right? So if their predictions are off or wrong, they're losing your money, right? Like people like me and you who work at full time W-2 and we're accredited investors. So it's really tricky. So that's why for me, the best way to know your cap rate is to honestly just talk to a few brokers. Hopefully, if they tell you, so a lot of times they'll lie. Or if you have other investors in the market, they'll tell you what the cap rate is. And the reason why I know what the cap rate is because when I do an appraisal, when I buy the property, they tell me what the cap rate is for the market. So because of that, I actually have data points, right, as to what the cap rate is.
Or that's like the standard cap rate for like that asset class, right? Is what you're saying. And then you kind of base it based on that standard, right?
Correct, correct. So like once you kind of know, so like in generally speaking, like the Southeast, right? Like more cash flow markets, it back then when I was buying in 2021, it's safe to say it's like an 8 cap market,
Mhm.
right? That was pretty conservative number. And if it's like a mobile home park, maybe it's a higher cap rate, right? So mobile home parks are more cash flow, there's a little bit more risk. So they'll underwrite it at a higher cap rate to cover that risk.
Mhm.
So it's just kind of like arbitrary math, but at the end of the day, like you just have to underwrite it in a way that makes sense for you, right? So
Okay.
like for me, I'll give an example. My 26 unit, I bought it for $500,000. They appraised at 750K day one. So I bought this deal of 250K instant equity. So what does that mean? That means that I cash flow very well out the gate. I was able to double the rents, double the NOI after renovations. And if you double the NOI, cap rate stays the same. What did I do? I just doubled the value of my apartment complex. It's now worth $1.5 million. So not only did I force about 750K of equity, it now cash flows about $8,000 a month, right? On top of that. That's the power of like a one deal and one deal in real estate, right? And that's almost enough to replace my W-2, right? Like, or most people's W-2.
Yeah,
So yeah,
that's absolutely crazy. Yeah, I think the cap rate stuff still kind of gets me, but I think there is a lot of nuance there. It's
yeah,
not so cut and dry. Because there's like pro forma cap rates, there's like current cap rates, and then there's a lot of other factors that you have to consider as well, right? Because yeah, like the property might be renovated, it might not be renovated. But yeah, super crazy stuff. I mean, but I did want to kind of jump to another topic here. So I wanted to talk about now kind of the meat of this video, which is how you find these properties now, right? So I'll give you my buy box now, and maybe you can kind of give me a sample idea what you would do. And so my buy box is somewhere about the 1 million to 1.3 million dollar purchase price. I'm not actually looking for a super value add because I guess my strategy is slightly different. A lot of mine is based on tax benefits and stuff like that.
yes.
But if I'm looking maybe for like an 8 cap, right, at 100 or sorry, $1 million, let's just keep it at $1 million, my buy box, close to there. at 8 cap, the NOI should be close to $80,000. Let's say this is Oklahoma. Let's say I'm looking at Oklahoma. How would you go about finding a property like that? You use PropStream to go find the property owners, right? But besides that, how would you kind of go about this?
Yeah, so kind of working backward from the numbers, basically the criteria for me stays the same, right? On PropStream, like it's basically 5 to 100 units, and then from there, once you start your mailers, owners start to call you, and then once you start gauging and getting financials, you can know what you can buy, right? So if, like you said, if you want $1 million property, you need a NOI of what was it, 80,000? You said. So basically, the expense ratio is 50%. So your total income must be double that of 160K. You divide that by 12. So like what is that? Roughly about
Oh, so
13,
you're
14
saying you're saying
in
that
rents.
um you're saying that a property that actually grosses 160 for a $1 million property, to me that seems like it would be a 16 cap, but then when you factor in a 50% expense ratio, meaning half of
Correct.
that gross income is allocated towards expenses, what are
Yes.
those expenses? Like what could be $80,000 a year in expenses? Are you talking about landscaping? Like I can't imagine that it would be $80,000. Where is that going to?
Yeah, I mean, well, out the gate, property management is 8 to 10%.
Hmm.
And then you have to factor in vacancy. Like you're not always gonna be 100% occupied, right?
Right,
Average is
right,
about
right.
90%. You have to cover the water bill as a landlord, right? You have to cover common area electricity, common area gas. The insurance is expensive for multifamily, right? I told you my 26 unit, my property tax or my insurance is 24K a year, right?
Wow.
This is not single family homes where it's $2,000, right?
Hmm.
It's a lot more risk, right? Because it's a business now, and then your property tax, in Oklahoma, it's roughly going to be about maybe another 12K. You have to do repairs and maintenance because people will trash up your units. There's gonna be turnover. There's gonna be
Some
evictions. You're gonna
reserves
have
for
you're,
CapEx,
you're
right?
gonna need reserves. Yeah. So like things break, right? Like things will break. So like I've owned two apartment complexes for like 3 years, and my expense ratio is minimum 50%. Right. I was being
Wow.
conservative just for easy math, right? So yeah, you're gonna have to gross 160K a year. Half that's going to expenses, and
And
then
my
at that
NOI is
point,
80,000 and I'm
now you have
at a cap.
yeah, and then
Wow.
plus you're factoring your interest rate, right? That's not even including your loan yet, right?
Right, right,
That's
right.
why it's hard to cash flow now with 8% interest rates unless you do a large down payment to have a smaller loan.
So, right. Okay, so let me stop you right there real quick. A little tangent here, but
Yeah,
if a property is an 8 cap, right? Right now the interest rates for DSCR loans is like right around 8%. Would any lender give me a loan if I put like 25% down on a $1 million property with an 8% interest rate, knowing that this is an 8 cap property? Like my cash flow is going to be negligible. Like it's going to be very, very tight because it's only producing an 8 cap and I'm getting an 8% interest loan, right? On 75% of the purchase price. So I'm really not going to be cash flowing that much. How likely is it that this DSCR lender is going to give me this loan? Or do
so
I need to start looking at creative financing methods?
yeah, so DSCSR, right? So basically, it's debt service coverage ratio. So most lenders want a DSCSR of
Okay, and
1.25%.
what does that mean?
So that means that whatever your NOI is, your NOI has to be 25% greater than the debt, the monthly
Right,
debt.
right.
So, for a simple example, if your monthly debt was $1,000, you have to be 25%, your NOI has to be 25% higher than that. So that's gonna be
I see.
1250,
And
right?
it's hard to
So
do with these high interest rates, is what you're saying.
correct. So if you have a higher interest rate, that means it's harder to have that 25% margin in NOI unless you do a larger down payment, right? Which is
Exactly.
why creative financing is becoming more popular. It's a tool that, I used and a lot of
Hmm.
people are using because you can either assume existing low interest rate debt or they become the bank. And then
Right.
basically you can negotiate whatever you want. So I think given this high interest rate market, if I was in the market right now, I'd be going for creative finance all day, right? Like
Yeah.
I
And
bought, yeah.
yeah, and that's exactly what I'm looking for. I forgot to mention that my actually only required criteria is that it needs to be seller finance. Just because I can't afford to put 25% down on $1 million property if I want to be buying one every single year, right? Like I want to be buying one or like more frequently, right? If I put 250K down on a $1 million property, who knows how long it's going to take me to get another $250,000. It's going to take me a couple of years. And so my velocity of buying assets is not going to be as fast. But I wanted to talk to you because I did download PropStream after we talked, and I was like playing with the filters, but the filters are not that accurate. Like I keep getting these lists, but when I look at the property, they're like not even, some of them aren't even multifamily properties. Like some of, like the list seems so inaccurate. Is there any like is there like a list that you use that's very specific for your buy box, or like what are some of the criteria that you would put, like what, or some like key ones that you like?
Yeah, it's hard because all those websites like PropStream and like Property Radar, they basically
Mhm.
pull from the tax assessor's office, and the tax assessor's office, they accurately codify things, right? So sometimes I do cast a wide net just to capture more, but yes, when I send out my mailers, I do get a lot of like retail strip centers, a lot of like office buildings. Sometimes they get self-storage, right? So
Right.
just know it's going to happen. And sometimes the addresses are not even valid either, right? So it's just part of the business. And that's how you cast a wide net. Because like you said, like, yes, it does suck, but once you land one deal, that one deal is enough to make or break.
Right.
So for me, there's not, I try to like, for example, for multifamily, I think there's like 10 criteria on PropStream that I use. It's like, garden apartments, triplexes and plus, duplexes and plus, fourplexes and plus, high rise apartments. I forgot whatever that's related to multifamily, as well as I do commercial. But the best way to do it is you go on LoopNet, find an apartment complex address, take that address, put it into PropStream, and then see how they codify that. Then you
Mm,
have to add that to your search as well,
I
right?
see.
So that's why I teach in my mentorship program, the students, is you have to validate it, but just know that, like you said, you are going to get a lot of random properties, right? Like I had multiple people reach out. I had a medical office building
Right.
guy called me, and you can wholesale those, right? If you don't want that for
Yeah,
yourself.
yeah. There was actually a filter called free and clear, meaning like
Yes.
only show me the properties that are free and clear, meaning the owner has no loan on it. Those are prime kind of, subject properties that you can maybe get seller financing from. Another thing is like I noticed that, a lot of, if I looked at, I was like looking in Charlotte, North Carolina, for example, and I saw that a lot of these multifamily properties on my list had the same owners. There'd be like 10 properties with the same mailing address. In an effort to kind of make your mailing kind of more efficient, are you only sending one letter, or are you sending like 10 letters for each property there? Like, because then you're gonna have to send 10 mailers to the same mailing address for each of the 10 properties. Or would you just kind of like edit out those like extra nine and just keep like, just send one letter to that mailing address?
Oh, I love, you must have studied my video on direct mail because that yeah, I would filter because from PropStream you can extrapolate to an Excel document and you can sort it by owner, and I would delete it so it only go to one owner.
Oh, I
Because
see.
a lot of times, they might have like a 16 unit apartment complex, which is four quads.
I
So it'll
see.
have four separate addresses. So for me, I'll try to consolidate because it costs money per letter to send out,
Hmm.
right? So I
Right.
do try to consolidate as much as I can. And typically, if let's say the address is invalid, I'll actually delete that. That it'll be mailed back to me, and I'll delete off my Excel doc. So I know for next time I won't mail it
Okay.
back to them, right?
So would
So
you just basically export that list, and then what do you get from that? You get the mailing addresses, and then you would take that to a like a letter direct mail kind of campaign service. I think you use like yellow, what is it called? Yellow something?
yeah, yell letters complete. So yeah, I basically have an Excel document of all my leads, and I have my letter template. So they basically merge the two documents together, and then basically yell letters complete will then send out my mailers whenever I tell them to, right? So I automate a lot of that process out, and you can do it yourself, but obviously takes like 8 hours to prepare 300 letters. And if you're a high income W two like ourselves, you're probably better off just working a W two, right? So that's why I outsource that. And at that point, that's the easy part. To be honest, the hard part is talking to the owners and building trust and building that rapport. That's the
Hmm.
part
Hmm.
where most of my students fail, and it's a soft
Right.
skill that's hardest to teach. To be
Yeah.
honest, unless you practice.
Well, so I think you said that you were spending like $300 a month on this direct mail marketing, right? How do you know what to stop sending a mail to a person though? Like I hear that, it's all about follow up. It's like the average number of times you have to send them mailers like 12 times before they ever like call you back or whatever. When do you know to stop sending the mail?
Yeah, so for me, what I try to do is I want to get about 1,800 leads, and I send out 300 mailers a month. 1,800 leads is good enough for 6 months. And like you said, you want to hit that 1,800 leads once every 6 months, times at least 7 times, right? So over a couple years. And a lot of times, like, people will like, I still have the contact information of owners I sent out letters to before, right? So if I'm ready to find more deals, I already have their number and their contact. So I could just reach out to them directly. Yeah, you just have to be really consistent and persistent. And that's where most students fail. Like, you have to be tenacious in the follow up because a lot of these owners, and I'll say this, multifamily owners are weird. It's really weird. You think they'd be super professional, super like business like. No, It's not that way at all. Like they're very emotional. Like I had one student, he wrote an offer, the guy agreed to the LOI, and then like all of a sudden he ghosted him for like 3 weeks. And then like after that,
Yeah.
he was just like, "Oh, I decided not to sell anymore." And I told my student was discouraged, and I was like, "Well, this is normal, first of all." And I said that what you should do is in your calendar every month, just put it in there. The second Friday of every month, whatever, make it up. Put a reminder to text or follow up with this owner every single month because their situation changes and people are very emotional, right? So
True.
you have to systematize things and just say, all right, put them on the back burner, but remember to follow up
Mhm.
because when you're top of mind, his situation may change and then he may want to sell to you at that
Yeah,
point.
I know that there's a tool for CRM. Do you use any tools for CRM?
It's Google Calendar. I keep it so simple. It's literally Google Calendar where I'll just put a reminder to be like, hey, to follow up. But yes, I do kind of have like because what I do is I have like 12 questions I use to talk to owners, and then typically like I'm with owners, I'm typing out, so it's almost like a word. It's very unsophisticated, but like to me, you don't have that many hot leads going on, like
Mhm.
especially between 3 letters a month. I mean, by hot lead, I mean like serious, like they're motivated to sell, you're motivated to buy, and you can tell that you can close on them because you can sniff out people who you think are serious at this point. Like at least
Mhm.
I can. Like you pretty much remember like what's going on. But yes, I do document it. It just could be as simple as Google Sheets. Nothing fancy on my end, to be honest.
So I think there was one, kind of question on my mind, which is, everybody's talking about, I think, at least for the first half of this year, everybody was talking about how the multifamily destruction is coming, or like this glooming, like, or like this like looming like threat of high interest rates, where a lot of multifamily owners had like bridge loans or short-term loans that were at very, very favorable interest rates, 3 years ago, but now they are forced to refinance today at interest rates that are maybe double or triple what they got 3 years ago. And so now, when this event occurs, they're no longer going to be able to meet their mortgage payments and they might have to default a lot. I haven't heard too much of this happening yet, but my main question with this is like, should I be targeting seller finance in this case? Because people who own their multifamily free and clear, they are not struggling whatsoever. They own these things free and clear. There's not so much of an incentive for them to sell these properties. They own it free and clear. Or should I be going for some of these owners who are in distress, who maybe, have a refinance event coming up? But the problem with that is I won't be able to get seller financing. I'm kind of torn between who I should target here. Should I be going for these distressed owners right now who may be willing to sell me a property at a discount because their refinance event is coming up or whatnot? Or should I be going for these seller finance owners who may be able to give me like a 10% down loan, right? I think I'm not sure exactly where the bigger opportunity is for me, but what would you say?
Yeah, I mean, you're basically describing two sides of a coin, right? There's one side's pain and one side's gain, right? So people who own it free and clear, they're focused on the gain, right? They want to make more money, they want to become the bank, and they want to continue getting that mailbox money, right? When you that's the ultimate goal in real estate investing, right? You want to not deal with toilets, tenants, and all that, and become the bank where every month on the first you get mailed money, right? No operations, just money, right? So people upgrade to that level where they own the apartment complex, they were the operator, now they upgrade to becoming the bank. So that one, it's a great one, right? And then the other side is pain. So those are the distressed sellers where maybe their loan's coming due, right? Like you said, they got a 3% interest rate and now it's going to be 9, right? So for me, I mitigate that by trying to get as long of a loan term as possible. So I do at least 7 to 10 years to lock in the interest rate, right? To give me cushion in case interest rates go up. But let's just say there's a situation where I did my 10-year was during this time where it's bad. If it was me, honestly, I would say, hey, give me your contact to your lender. Let me talk to them and see if we can create a win-win situation, because the bank doesn't want that person to default because now it's on their books, right? So sometimes you can negotiate something if you can come bring in and bridge that situation. So I think in either way, you can make money, right? But it's just a matter of what problems do you want to solve, right? If it's the gain side, it's a little easier, right? This guy just wants to make money and wants mailbox money. That's a lot easier to deal with versus somebody who's in a bad situation and you maybe take it over subject to, so it just depends like what your strengths are. But obviously if I had to pick, then I'd focus on the gain side, right? On the pain side, it's a lot more stressful. Yeah, I sold mine. I was a distressed seller and I sold mine with creative finance. And obviously when I'm stressed, I'm not going to be as fun to deal with. right? So if I had to pick, I would probably lean towards the seller financing over the distressed seller.
Yeah. Yeah, me too. I think generally for my strategy, I think, a lot of what I do is buy real estate, bonus depreciate it, and use the losses against my W-2 income, right? That's what my channel is kind of based off of, right? It's helped me avoid 99% of my federal income tax in 2022 and 2023. But bonus depreciation is going away slowly. And I'm like praying that it comes back in this new tax bill called the Tax Relief Act for American Workers. If you guys don't know what that is, that's a bill that's being introduced, already passed by the House, but it reintroduces 100% bonus depreciation for this year if it gets passed. So everybody, all real estate investors are like praying for that bill to pass right now. But yeah, I guess I wanted to maybe close out here. You did say that you are going to get married soon. And so maybe we can shift over to my area of expertise, which is real estate professional status. I know you know a little bit about that. And so when you get married, is your plan for your spouse to become a real estate professional? And if so, what's the strategy after that?
Yeah, yeah, it's something I've been planting in her mind. She's not happy to hear it, but it takes time to plant these seeds and let them grow, right? Just like with building wealth. But
Yeah.
ultimately, right now I don't qualify as a real estate professional, despite having so many passive losses from real estate because I have active W-2 income. When you work full time, you don't qualify as a real estate professional. But if you're married and your spouse or partner qualifies collectively, you qualify, right?
That right.
Um, and that's where what you're doing, right? And so for me, I actually am working on my real estate broker license, going straight to broker, skipping agent. And then from there, I want her to work underneath me as an assistant or as a realtor. And then she's going to cut down to part-time hours and then make sure that she documents hours more so in real estate to then qualify as a real estate professional to wipe out my W-2 income, right? So that is our plan. We're getting married in March of 2025. But I imagine maybe within 3 years, I'll probably definitely be jumping on the real estate professional status, or if not sooner, because situations change once you have kids and start a family, right? And sometimes people want to step down to part time. So no, definitely excited to jump on that because I'm taxed at a 4% tax rate, so just alleviating 40% of my income by her going down to part time, probably we make the same or if not more, right? Because it's
Yeah,
not how much you make, it's how much you keep, right? That's really
exactly.
the game.
Yeah, yeah. I think that's a super good strategy. I mean, you always have to pair you always have to pair real estate professional status with buying real estate. It's only when you do both then you get these tax benefits. But it seems like you already have some suspended passive losses, like you mentioned, that are just kind of in storage that you can just kind of unlock once you become a real estate professional and wipe out your active income. So that's an amazing strategy. But we're not going to talk too much about that. I think that's pretty much all the questions I had. If you had any other resources or words of advice for the audience, again, my audience is mostly high W-2 income earners. A lot of them are interested in multifamily, but just like me, they're a little unaware of how to actually go about it. And even the whole conversation we had about cap rates is still quite confusing to me. I don't know. So I feel like it's a little bit higher barrier of entry, but if you had any resources available, maybe you can share with the audience, what helped you out the most in terms of like making that first decision.
Yeah, what really helped me because I was in that same situation, right? I was high income W-2. I owned a couple single family homes, and I joined a mentorship program. And once I started seeing people just like me and you taking down multifamily deals every day, it really motivated me and made me realize it's possible, right? And then once you realize it's possible and doable, then it really opens up the opportunities, right? The moment I joined that mentorship, within like that year, I bought 80 units, right? Really
Yeah.
rapidly.
What was this mentorship
Um,
program? And how much
um,
does it cost?
I think there was $15,000 barrier to entry to get in, but they do take half of your equity in your first deal, which I didn't like, which has kind of inspired me to do my own. For me, it was just really that belief mindset shifted that helped me. I mean, in terms of doing it, it really helped. And what helped my student is like just having someone more experienced than you walking you through it. Because like you said, for you and for new people, it's intimidating, right? But for me, I've done it like 3, 4 times already. I've helped multiple students do it. So for me, it's like nothing new, right? Like my student was like freaking out, and then I'm just like, oh no, like this is completely normal. And it's nice to have that like third party who's unbiased, not emotionally involved to give you that opinion. Even myself, right? I've done this a lot. Even I get emotionally caught up, and then I don't even listen to my own advice sometimes, right? So it's just really nice to have that extra set of eyes. someone to check over you to make sure you're doing it correctly. And
Yeah.
but the key is you just have to get started. You have to self-educate and don't go in alone, right? And then whatever money you're gonna throw in, expect to lose it, right? Like make sure it's money that you can't afford to lose. And that's why I value my W2 job even more now because I went through real estate, right? Like you can make $1 million on a deal, great. Or you could easily lose, like on my mobile home park, I lost 100K. But what allowed me to sustain was I had a W2 job, right? It sucks to lose 100K, but I was able to still have a roof over my head, food on the table, pay my bills because I have a W2. And when I lost money on my mobile home park, guess what happened? It offset my W2 income. So I got a nice tax refund for this year, because I wiped out 100K of my income. Don't take it for granted. I know a lot of people go into real estate to leave their W2 and they want to leave the soul sucking W2, but trust me, once you start doing it, you're going to appreciate your W2 more as you go through the
Yeah.
journey.
That's actually so
So,
true.
yeah.
Yeah, I,
So,
I would say I gained a new level of just to like I appreciate my job a lot more after working in real estate or analyzing these deals and realizing like, damn, even if it cash flows $1,000 a month, that's only $12,000 a year. Like I am not getting any closer to replacing my W-2 anytime soon. If anything, that's like so ironic, right? Because it's like
yeah.
we started this to get out of our job, and then what we got out of it is more. We appreciate our jobs even more.
Exactly. That's why I was laughing. I was like, dude, 3 years ago, I hated my job, bought a bunch of real estate, and then realized, you know what? This job's actually easier than real
It is
estate.
easier. Yeah, it is easier. Passive income is so
Yeah.
hard to make, man. But yeah, with that, I think you do offer a course yourself, right?
Yeah.
What is that called?
Yeah, it's Making Multifamily Money. Happy to drop my link tree, which has all my socials. I do post a video every day talking about real estate, multifamily, personal finance, and a lot of more mindset stuff recently as I've been kind of pausing to show transparency as to what it's like to really own real estate. 'Cause, it's easy to say, hey, I cash flow 14K a month and I replace my W2 income, but I know the reality is not truly the case, right?
Yep.
So happy to drop that, but I mentioned a program is called Making Multifamily Money, and it's kind of geared towards those who are, high income W2, own single family homes, and want to take it up to that next level to dive into, multifamily real estate.
Yeah. So mostly what we talked about today, but in much more detail, I assume. I
Yes.
think to be honest, I'm looking to build my own course right now, but I would say the most of the value is in the mentorship rather than the
Yes.
course itself. Would you say?
Yeah, so the most value is just the networks and the connection, right? So
Right.
just being able to get the baseline knowledge, right, in an organized fashion. It's nothing new, right? Real estate doesn't really change over time, but having somebody that can help analyze deals with you and give you other alternatives or creative strategies to take the deal down, right? Because there's always a way to make a deal work. It's just, can you think creatively enough to make it work? Right. So it's like, how
Right.
can I make this work and make this a win-win situation? So that's the most value, to be honest, is just the coaching, the one-on-one aspect, and just surround yourself with people who are actually killing it, right? Like, why would you follow somebody who just, if you want to buy an apartment complex, you don't want to follow people who own a bunch of single family homes, right? You want to follow people
Right.
who own a bunch of apartment complexes. So it just all that it benefited me significantly. That's how you expedite your journey to financial freedom. And like I said, do you value time or money? If you value time, then you pay to expedite your path, right? If you value money, then you're going to pay something called the stupid tax, and it'll take you longer. And that's okay, right? We're all young here, right? I'm in my third, I'm 34, and own more real estate than I ever thought I would, right? At this
Yeah.
age, and but because I was able to shortcut my path, I was able to do it faster than most people, right? And if there's younger people than me that join, they can expedite their journey even faster than I did it, right? So that's the whole
Yeah.
point of mentorship, is expediting your path in your journey.
Yeah, and I think I'm that kind of at that stage of my life where, when I was in college, I didn't have $5,000, so I wasn't going to spend my life savings to learn about real estate. But now, $5,000 is not much. That's like, just maybe, I don't know, a couple weeks or whatever work, and you really can go so much faster, right? Like even when I was building my course, the first time I tried to build a course, I tried to do it all myself. I ended up quitting. But now, I just paid someone $3,000 to build my website and all my other email marketing done in like a couple weeks, And so for me, that's way more valuable. And the same applies here. So yeah, well, last things, I guess, where can people find you? What's your socials or where are you most active?
Yeah, mostly active on YouTube. You can probably search Stephen D. Nguyen or Making Multifamily Money. Happy to give you my link tree to drop down in the bio, easier. But
Cool.
if you search that, I typically pop up. Even if you type in pharmacist, real estate investor, I'm probably the number one on that one.
Oh, nice.
So pretty
Nice
easy to
little
find
niche.
me. Yeah, a little niche there. And I'm pretty responsive in terms of the comments and even my email. So happy to
Okay.
give people my email as well.
Yeah, well, thanks for joining, Steven. And yeah, you guys go watch his content. It's really cool stuff. I mean, a lot of what he talks about is really candid. So I really love that about your channel. But yeah, if you guys found this video useful, you guys can like and subscribe, and we'll do more videos like this, kind of interviewing other real estate professionals. And yeah, thanks for joining again, Steven.
All right. Thank you, Michael. Really appreciate sharing my journey. Thank
All
you.
right. See you guys.